Good evening, everyone. I'm sure we are all keeping safe, all excited for yet another session. I'm pretty sure that you guys got some chance to go back after the day before yesterday's lecture, wherein we talk about the capital budgeting techniques and did some understanding of why capital budgeting is relevant, the aspects of non-discounting method, discounting method. So I'm pretty sure that you were able to understand a lot of stuff, especially the discounting methods and also the aspects of decision evaluation. When do we accept a project? When do we reject a project? So that is a very, very important aspect, especially with respect to IRR, where we had stopped in our last lecture. So again, wishing you all a very welcome to the second part of the same, and a good evening to all of you. I can see a lot of excitement coming on to the session already. I can see a question coming from Ria that what is block of assets? Ria, I explained block of assets. It's a rule as per the Income Tax Act that you would be studying if not yet already with respect to the the depreciation rule. So in Income Tax Act, generally what we do is we charge the depreciation on a block of asset. Let's say you have a block of a machinery. Now there are 10 machineries, you are charging the depreciation on that until and unless there is even a single machinery in that block, there will be no gain or loss on the sale of machineries within the same block. So that's what we generally consider. Right. So I hope that makes sense. So I just want a confirmation, guys. We ended our lecture on the understanding of the IRR method, but I wanted to make sure that have you guys tried this question already? I requested you to do this as a homework with respect to the IRR. We talk about the conclusion aspect as well with respect to the requirements that when the IRR is more than the WACC, we do definitely an acceptance of the project. Logic being that my NPV shall be positive because WACC is a lower rate. Okay, so that is something I expect. Okay. So guys, can you please confirm if you guys have done the IRR example which I gave you as a homework, please? Sandeep, irreversibility means that the decisions once taken, this is for long term. You generally don't reverse, you take a U-turn in a capital budgeting decision. Ria, we will be covering some of the questions. I am not sure whether the example 6 has been selected over here, but yeah, we'll try to cover. I think your question might be covered in another example which is already taken in this particular lecture. But Sandeep, I hope the irreversibility makes sense. And guys, can you just please confirm those of you did that homework for the IRR, please? I'm just wanting to see a confirmation. How many of you did IRR homework? I can see some responses coming in. Okay, done both the questions as homework is confirmed by Rohan. And I'm sure many of you would have done, but anyways, let me just quickly, those of you have not done it, did not get a chance to work on the same. I probably can quickly walk through. What we do generally is, looking at capital cost of a 360 here, 360. 5 years is the span of life, and the salvage value is at the end of the day is nil, and the machine will be producing a net operating income after depreciation of add back the depreciation here. So depreciation is 360 divided by 5. So we are getting the first step is a cash inflow of 1,09,400. That's what we have. Okay, so that means cash inflow is my first step. Now we need to calculate the IRR of this particular project. Now guys, are we having a uniform cash flows in this case? I guess yes, right? So if we have the uniform cash flows, we probably might want to see that, hey, my outflow was 3,60,000. Now this is the uniform cash flows. I can straight away divide this 109,400 and I get is a 3.29. Now the problem is that, if I look at the factors given to us, 3.29 is the number which I am getting, 3,60,000 divided by 1,09,400. So what we are doing here is initial investment upon the annual cash flow, annual cash inflow. What we are getting is 3.29 is my present value annuity factor. Okay, so 3.29 seems to be falling under these guys, between these 15 or 16. Now, looking at the numbers, can you tell me, is this closer to 16% or closer to 15%? Anyone should be able to tell this by a naked eye here. Is it closer to 15 or 16%, guys? I'm getting 3.29. What are your thoughts? I think 3.29 is much closer to 3.27, right? So probably the IRR should generally be around closer to 16%. But yes, what we need to understand here is probably we are looking at a calculation with the two random rates. Remember the formula I explained you. We are not getting the exact factor here. So the better idea would be to calculate NPV at two rates. We know that it is following under 15 and 16. Why don't we select a 15 and a 16 maybe, right? So so that means it is closer to 16 here. Okay. So that means we are looking at a scenario of the NPV at two rates, so 15% and 16%. So my NPV at a 15% is a 6,490. That's a positive, and I told you we need two NPVs. One should be positive, one should be negative. Now the negative would be a higher discounting rate anyways. So 16% is giving me a negative 2262. So if we apply that formula, we are getting a 15.74%. I think you guys were absolutely spot on to select a 15.74% here. You guys are absolutely spot on. This was a closer to 16%. Yeah, so Saurabh, Tanu, Meman, Sushil, absolutely correct. Khushi, you as well. So it is 15.74, guys. I hope this makes sense to everyone. Okay, so let's move on. Now let's talk about brainstorming here. This is a very interesting question, guys. One of my favorite ones. Let's see if you guys can crack this one. Let's see who can give the answer for this, please. Okay, let's see what are the answers I'm getting here. Waiting for your answers, guys. Which of the following events would decrease IRR here? Till now, I've got answers from Sakti and Narayanan. What do you guys have to say on this? Let's do one thing. Let's take this question to a different zone altogether. So let's see what are the other responses I'm getting. In the meantime, let's do one thing. Let's talk about this question, because I can work at, what I can see is different answers coming in from different students here. So let's talk about this. So the questions you can see right now is which of the following events would be decreasing my IRR? So this is a very, very interesting question, trust me. Okay, I'm getting answers A, C, and D. Okay, that's okay. Guys, don't worry. Let's start to understand when we are looking at IRR. How do we calculate the IRR? We know that at IRR, my NPV is 0, guys. Okay, guys, I hope now I am back audible and absolutely you can see the screen. There was some disconnection due to technical difficulties here. So guys, we were talking about this particular question here, in which we are looking at what is IRR. So let's talk about IRR. Is where my NPV is 0. I'm looking at NPV is 0. So that means let's calculate something. Cash flow in year 1 into 1 plus R. Cash flow in year 2 into 1 plus R square. And so on. We go on to cash flow of year N into 1 plus R to the power N. Minus initial investment. So that's equal to 0. That's the NPV formula, guys. Guys, I hope everyone makes sense here on this one. So that's the IRR formula, simple. this is nothing but present value of cash inflows. This is the initial investment. So let's talk about option number D first. Use the written down value method instead of straight line method for depreciation. Guys, if I use a written down depreciation, this means more depreciation in early years. And if there is a more depreciation in early years, do you agree that the cash flows will actually go up, will increase, because more tax shield. Cash flows of initial years will go up, guys. Cash flow for year 1, cash flow for year 2 will increase because there will be more depreciation tax shield, because I am moving to a written down value. And if that is the case, your IRR should, for a NPV to be 0, what should happen to my discounting rate? If my cash flows are more, I guess rate has to be increased, guys. The call of the question is, which option will decrease the IRR here? Option number D, my rate will be increasing. Guys, make sense? Option number D cannot be the answer. Option number D cannot be the answer. Because my cash flows are increasing, NPV has to be 0. No other aspect has changed. D cannot be the answer here. Now, what about option number C here? I hope everyone is clear with option number D though. D cannot be the answer because my rate of return is going up for a NPV 0, because mind you, my initial investment has not changed. For a NPV 0, I have to increase my IRR in option number D. Guys, I hope this is clear to everyone. Now, what is happening in option number C? Let's see that. Option number C, shorten the payback period. Guys, that means again we are saying more cash flows, more cash inflows in earlier years. Make sense, guys? So if my cash flow in year 1, cash flow in year 2. What about B? I ask, can you mute? I guess there is a sound coming in from the backside. Just give me a second. Okay, so guys, let's talk about option number B now. What's happening in option number B? Option number B says, I am decreasing the related working capital requirements. Okay, so that means cash flow year 1, cash flow year 2, this is not changing. Cash flow for year N not changing. Okay, just give me a second, guys. I think we need to just request the IS, can you just mute your side, please? There is a background noise here, please. Thanks. So guys, everyone with me, I guess. So option number A and B, C and D are not the answer. We are working on option number B. Option number B says decrease the related working capital requirements. Guys, that means my initial investment is going down. My initial investment is going down, guys. My initial investment is going down because I am decreasing the working capital requirements. Now, again, to arrive at an NPV at 0, because my initial outflow is going down, I'm forced to raise my rate. Because I don't have any choice, friends, in the option number B. My present value of cash inflows have to go down. because my initial investment is going down and my NPV has to be 0. Because my cash flows are not changing, the only option I have is actually increasing the interest rate. So that means even option number B cannot be the answer. I think some of you started telling me that answer is B. Even B cannot be the answer. And that means the only leftover is the biggest setback. I would say some of the students might be shocked. How come A is the answer? But I think I can see initially some students, Shakti, Pooja, and Sandeep, I think some of the students told me answer A. And I probably feel that you guys got it right. So good round of applause who thought that the answer is A, guys. Now, why the answer is A? Let me explain you. Again, decreasing the tax credits on the asset. Guys, what is a tax credit? Can anyone explain me decreasing the tax credit? Again, there is no change in the cash flows, guys. Cash flow for every year is not changing. So for any year, my cash flows is not changing. But tax credit is just like a subsidy. Subsidy. Let's say I am purchasing importing a equipment and there is a subsidy given by the government for the import duty. If they decrease the subsidy, my initial investment will go up. And that means for that, my present value of cash inflows have to increase, guys. And we don't have any choice, but this will result in a decrease of rate of return, because if I discount by lower number, I will get a higher present value. So answer number A is absolutely correct, guys. One of a very, very interesting and concept resolving question is this one. If you understand this question, you understand IRR, guys. So option number A is the right answer here, guys. I hope everyone understood now why option number A. Okay. Charu says, please let us take the screenshot. Sure, Charu. Let me go back. I'm just zooming out so that you guys can take a screenshot of the solution. Guys, I have just zoomed out intentionally so that you can take the screenshot, please. Guys, does it make sense? Option number A. I liked Abhijit's answer. Abhijit says, slowly getting there. Slowly, that's absolutely, Abhijit, that's absolutely fine, right? Slow and steady wins the race. Don't worry. If you're getting slowly, definitely with in-depth reading and probably practicing, you will get it definitely. You will reach your target. So it's better late than never, right? Okay. Okay, so I hope Pooja, Charu, everyone has taken the screenshot. So let's go ahead. So there are certain issues probably we need to discuss. IRR, NPV could also give some conflicting decisions. Before we go for some detailed practice, let's quickly talk about that. Now, I already explained you that in my last lecture that there could be an issue where a mutually exclusive projects are there. Mutually exclusive is like you accept one, you reject other. Because the logic is IRR is expressed as a percentage, whereas NPV is an absolute measure. NPV talks about in terms of amount. So there could be a question that, okay, let's say one project, if I'm talking about project A and project B, let's say NPV says you select project A, but IRR says project B. Then what do? So generally we go for an NPV method, but at least we need to understand that what are the issues here with the IRR. So one is that probably it's just expressed as a percentage. So you're not taking into scale of the investment here, quantum of money invested and earned in absolute terms. That is one issue. And the second issue is, what about where there are multiple investments during the project also? What about there are multiple investment? Let's say after 5 years, there is more working capital. In that case, we are looking at multiple cash outflows. And that would result in a changing sign or reversing during the life. Because my initial investment is coming more than once. My initial investment is coming more than once. One today, one after 5 years. So that in that case, probably I might get a multiple IRRs. I have to select multiple IRRs. So that could make our life difficult to use IRR there. Now, there is a very important assumption in both the methods, guys, NPV and IRR. In the NPV method, we take an assumption that all the cash flows are reinvested at the discount rate at which we are calculating the NPV, which is more logical. However, in the IRR, we are assuming that there is a reinvestment at project's IRR, which is not that logically because see, IRR would generally favor only those projects which are having more inflows in the earlier years. Because IRR telling you, okay, IRR has to be more than WACC. That's it. And not only that, if there are more cash flows, the gap between the WACC and the IRR would be more and more. Because if I am having a more inflows in the beginning, then probably we need to understand that yes, the difference between the the two could be more, the WACC and the IRR. But anyways, so this is just that you should know that okay, there are different reinvestment assumptions. Reinvestment means that whatever the cash flows you are generating, getting reinvestment in the business. So that's part about this one. Now, about the overall advantage of the discounting techniques, of course, we need to understand the time value of money is considered, definitely. But yeah, the calculation could be a problem. Assumptions of the reinvestment at IRR could be a problem. So you might get confused which method to be selected. That's okay, but you generally prefer NPV, generally, unless there are other risk factors that kind of indicate that yes, let's go for an IRR project then. Okay, so the next discounting technique method is actually what we did already in the last class. We are already done with the discounted payback, guys. I hope everyone remembers that. It is nothing but we're talking about a payback method in the cumulative approach. We just use the discounting technique. So this is already done in our last lecture. Now, the one method which I would like to talk about over the next 5-10 minutes is modified. It's not modified, it's modified internal rate of return here, right? So we're looking at a terminal value method where we are looking at, okay, it eliminates some limitations attached with the conventional IRR by, like what happens is that we are talking about, hey, what is happening in the traditional or a conventional IRR, what happens with the multiple outflows? So that's a limitation. So what is a limitation attached with the conventional IRR? Right? We're talking about a multiple IRRs where we have a multiple cash flows. So we're looking at, okay, multiple cash outflows in this case. And then we are looking at also a reinvestment issue. Now, what does that mean? What is this rate talking about? Modified internal rate of return. What we are discussing in IRR is we are discounting everything today's date. We are discounting everything to the today's date, right? Till now, whatever our calculation is, basically we are taking everything back to today's date. We are discounting everything. And the problem is, well, let's say there is an outflow here, there is an outflow here. Rather we do a discounting, this method is adopting a different methodology altogether. It compounds all the cash flows. Now we are not discounting it, we are compounding it. Whether it is an inflow or outflow, we compound all the cash flows except the initial investment to the terminal value, that is towards the end of the project. We use the same route, same rate. So what we are doing here is now, on one hand, you have an initial investment. Then over the different years, you might have inflows and outflows. Now what we are doing is we are compounding now. We are compounding these towards the end of the project, guys, instead of discounting. We are doing a compounding here. Now that means once we have compounded all the cash flows, what exactly do we have? What we are doing here is probably that, okay, we are seeing that there is a single outflow in the 0 year initial investment, and then we have different cash flows in the multiple years. So what is modified internal rate of return then? Now, MIRR is the discount rate which equates the present value of the terminal cash inflow to the 0th year outflow. That means whatever the compounded value, MIRR is more than required rate of return except the project. The only thing this method is helping us is when there are any outflows during the project as well. If there are during the project, there are some outflows, you are anyways compounding everything towards the end. And then you are saying that, okay, at what rate I should discount it to bring it to the initial investment. Okay. So Pooja says, what is meant by terminal cash flow? Pooja, terminal is last year. So we take all the cash flows, we compound it to the terminal value. Terminal means at the end of the project. So that's what we are doing here. So let's talk about an illustration here to quickly understand this. An investment of 136,000 yields the cash inflows, that is profit before depreciation, but after tax. Look at that, guys. They have already given you the cash inflows. No need to do anything else. They're already talking about cash inflows here. That is profits before depreciation, but after tax. That is, again, we are looking at 30,000, 40,000, 60,000, 30 and 20. So initial investment is 136 and we're talking about cash inflows of 30, 40, 60, 30 and 20. Now we have to calculate MIRR considering the 8%. So let's talk about this. Now that means we are compounding these factors, guys. Look at this. These are compounding values. We are taking all these to the 5th year, guys. First year compounded for another 4 years to take it to the 5th year. Second also to the 5th, third also to the 5th, and fourth also to the 5th. So this is a single number which is a compounded value, guys. Guys, can you please confirm if this compounded factor is clear to everyone? Instead of discounting, I have a 2,13,587. That's my compounded value. Now we at this stage we have two numbers. We just have two numbers right now. This is my today and this is my 5th year. So on 5th year we have 2,13,587 and today we have 1,36,000. Now we have to see at what value can we discount, at what rate can we discount 2,13,000 to equal, that becomes equal to 136,000. So that means we have to arrive at a present value factor here. We are looking at a present value factor, which is actually a 0.6367, because see what we are showing here is that 213,587, we multiply that with a present value factor here. And that should give us a 1,36,000. And hence my present value factor is a 0.6367. And if we look to the annuity table of present value of a single amount against 5 years, that will be around 9%. That is something which you can check from our annuity table, guys. Guys, I hope MIRR is clear to everyone. So there are two things. First, we take all the inflows and the subsequent outflows to the last year. Then we bring it back. We calculate one single present value factor, which will equate it to the initial investment, which is nothing but 9% in this case. A 9% in this case. So any thoughts, guys, on this one? Can you please confirm? In case anything you need to ask on this, please let me know. In the meantime, let me just show you something. So the factor we are getting here is So the factor what we are getting in that one. So we are looking at some present value factors of a single payment. Now the period was 5 years, isn't it? So in this particular table, what we are looking at is a 0.6367. 0.6367. Yeah, this one, to determine the present value of a single payment. So we are looking at 5 years. If I go here, probably I might be looking at, okay, that, hey, this is roughly around here. It's roughly coming around here, 6.5 or 6.4. So that means looking at the annuity table, what we are getting here is that, okay, my MIRR is around 9%. Okay, Charu says that it was buffering. Guys, is my audio not clear? I'm not concerned about the video though, but I think audio should be clear, I guess. Okay, guys, can you please check your connection, please, as well? Yeah. So guys, you guys please refresh your connection. Maybe it would be better then. I just confirmed with the IT team. My side, things are absolutely perfect. So, so I can just quickly tell you guys one more time that in the MIRR, what we are doing here is, if this is my project, we are compounding all these inflows or even subsequent outflows to the later stage. Let's take all these values to the last terminal year. We are compounding these values. We come up with one single amount here. We are saying initial investment here, and we are seeing that, okay, hey, now we have one amount after 5 years and one amount today. At what rate do I discount that terminal value to get the today's value? That's your present value factor, nothing about it. So we're looking at around 9% in this case. Okay, guys, I hope this one now makes sense. Now, let us quickly talk about also, okay, thanks, Jamil. So, and even Narayanan confirmed everything is clear and audible. So Pooja, because we did a compounding first and then discounting. Pooja, the answer is the compounding, and initially we were compounding. Jamil is asking me how to compound in the calculator. Jamil, we have to just multiply the number. So if you ask me how to calculate, let's say you are investing 10,000 for 10,000 today, and you want to see the value of after 4 years. Let's take an example, and 4 years, and the interest rate is 10%. So in the calculator, you will multiply this 4 times. That's it. That will give you the compounded value. So guys, compounding values formula was amount is equal to principal into 1 plus R to the N. So P is the present value, A is the compounded value, future value. That's what we do. Okay, so guys, let's move on, please. You can probably do some calculations and validate your understanding. Let's now understand. Okay, Charu, Pooja, thanks for confirmation. Now let's move on to the facts I was mentioning a couple of slides ago about NPV and IRR. Now NPV and IRR could give some conflicting conclusions. I already told you that one is a relative measure, one is an absolute measure. So the reasons for the disparity could be a scale or a size. You could see this. Project A is a smaller project, so IRR says project A selected. But if I look at NPV says, okay, select project B. Because there is a disparity in the size. Absolute measure you will get a higher NPV for multiple investment. Some of you might say, on a lighter note, some of you might say, let me actually, I'm sure some of you might think from that perspective that why don't you select 5 projects A? 5 projects A. So you will get a 36,000 into 5. But it is all hypothetical assumption that, hey, would you have 5 projects like project A? You don't know, right? Would you actually have 5 projects? You don't know. These are hypothetical assumptions, right? So we can't assume that, okay, hey, well, let's do project A 5 times. Is that required? Not absolutely not. Okay, so now time disparity in cash flows is also another factor. You could see that there could be some projects wherein you have some disparity in the cash flows. So let's look at the example. In the project X here, you have initial heavy inflows, 2 lakhs, 1 lakhs, and you have a IRR of 24.87. In project Y, you have a significant cash flow in the third year, and you have a higher NPV. So that means NPV says select project Y, IRR says select project X. I already told you that there will be IRR will generally probably that will favor the projects which have a more inflows in the earlier years. And the question is which method? Generally NPV, but if you may consider that, okay, risk also you want to consider. In the project Y, inflows are too much later. It requires more investment initially, and there is hardly any difference in the NPV. You may go work with the project X. So that's the management decision, right? That's the management decision. Then you could see there is another scenario where the projects with the unequal lives could be there. So look at the project X here. It's giving the entire returns in only 1 year and giving you a good IRR of 50%. But project Y with a similar investment is giving you multiple years returns. And look at year 3, 7 lakhs. And look at the NPV. Huge, almost double, guys. IRR is slightly less though. I might go with project Y. Unless and until I think that, okay, my criteria, management I want my money as soon as possible. I'm considering payback. Then it is a different scenario. But the idea is that you might want to have some kind of a criteria which could help you. There is one method which we'll be talking about in a subsequent slide, which talks about a replacement chain method and also a equivalent annualized criteria. We'll talk about that, where you have a conflicting decisions. Can some formula, can some model help us to make a right decision? We will talk about that in brief in a while. Now, certain special cases here. Let's talk about that before we come to those methods. There could be, if you remember our initial discussion, the capital budgeting is important because generally you will have a limited resources. You might have a limited capital. That means you are talking about a capital rationing here. Now, projects with having a positive NPV should be selected. Simple. If you have a limited capital, you say that, positive NPV should be selected. But the problem is, if I have a limited capital, I might want to select combination of those projects which give me the highest NPV. So that is very logical. So there are 2 cases here. There are 2 cases we need to understand. The possibilities are there could be projects which may be, generally if you ask me, generally projects are not divisible. If my projects are not divisible, then probably I might end up with not investing the entire money. But what if there are projects which you could take part role? Let's say 2 companies pitch into a project. You can take a part of the project. So let's talk about our discussion in the sense where a project is divisible or not divisible. This is an interesting case. I am talking about that, my constraint is my capital. I have limited investment. I might have to select some best combination which gives me a good NPV or a best NPV. So first case is where we are looking at, in this case, scenario 1, which says my projects are independent, but they are also divisible in nature. That means you are actually able to take part of the project. In that case, you should rank the project basis NPV per rupee of capital method, guys. NPV per rupee of capital method. Now, the projects which are not divisible in nature, in that case, we will be ranking the projects on the basis of absolute NPV. Guys, be careful. If a divisibility is an option, what I will do, I will divide the NPV by the initial investment. I will divide the NPV with the initial investment. I will see that, okay, which project is giving me the maximum NPV for per rupee invested. That's where the projects are divisible. But when the projects are not divisible, you take it or leave it. You will rank the absolute NPV projects and take the maximum possible NPV combination. You may end up with some of the resources, let's say, not utilized. That could be a possibility here. Okay. So let's talk about an illustration to understand this. Parvati Limited is planning its capital investment program for the next year. It has 5 projects, all having a positive NPV. Wow. All having a positive NPV. And the compounded company's cutoff rate is a 15%. Investment outflows and the present values being as follows. And company has a maximum 1,20,000 to spend. So let's see. So we are looking at 5 different projects and they are asking us to that as per the best limit, my budget is only 1,20,000. Which combination should I go for? Which combination should I go for? So these are like the investment in thousands. Let's talk about this. Now, you have 1,20,000. I am telling you all the NPVs are positive. You would say that, sir, let's do all the projects. Can you do all the projects? No, sir. Because if I add the investments, 50 plus 40, 90, 90 plus 25, 1,15,000. 1,15,000 plus 30, 145 and 35, 1,80,000. You needed 1,80,000 for all the projects. Do you have 180? No, you don't have. You have just 1,20,000. That's it. So in the last slide itself, it is saying that capital spending is limited to 1,20,000. So now let's see whether my projects are divisible or not. Let's assume that if my projects are divisible, what happens? Guys, if my projects are divisible, what happens? I need to calculate NPV per rupee of capital invested. So that means my NPV is given to us 15.4, 18.7 or in thousands, whatever. So what we are doing is NPV per rupee 1 of investment. That means what we are doing is we are dividing the NPV by investment here. We are dividing the NPV by investment. 15 upon 50, 0.31. 18 upon 40, 0.47. And when I did that, I'm looking at a ranking here. My first ranking goes to project E, guys. Remember, projects are divisible, by the way. When the projects are divisible, it is highly likely that you will invest every amount because your project can be divisible. You can accept part of the project. So I go ahead with project E. I'm spending 35,000, guys. Let's talk about this. So we have a divisible project here on the top. So you select project E first and you exhaust 35. How much you are left with, guys? Remaining money? You are left with 85. Okay, the second rank is to project B. Okay, go to project B. You spend another 40 and you are left with 45. Everyone with me on this? Now the third rank is project C here. You select project C also and you spend 25. Now you are left with only 20,000, guys. So guys, we have selected project E, B and C. And what we are left with is 20,000 bucks. Make sense, guys? Does this make sense? E, B and C. Is that what you're rejecting or selecting? Basically A, B and C, project E, project B and project C, all these three projects selected, and you're left with 20,000. Because what we are saying is that the projects are independent of each other and are divisible. That is, part project is possible here. Abhijit is asking what is divisible and what is not divisible. Abhijit, we are talking about project. So divisible means you can take a part of the project. You can invest in part of the project. Let's say another company is also joining you. Indivisible means that you can only take the entire project. Only one company can handle it. Okay, Abhijit? I hope that makes sense. Okay, so you're left with 20,000 bucks, guys. You're left with 20,000. What is rank 4? Rank 4 is a project D. But project D requires you to spend 30,000. Do you have 30,000? Yes or no? Sandeep, I hope that is clear now. Yeah. So 30,000, you don't have 30,000, you have 20,000 only. Okay. Since you have 20,000 funds remaining, you can take 2/3 of the project D, guys. So you can take a 2/3 of the project D because 20,000 can be invested. So you take project E, you take project B, you take project C and take a 2/3 of project D. That means you are rejecting project A here. Project A is rejected, and that is what my investment decision is. But mind you, this investment decision is when we are saying that part of the project is possible here. Part of the project is possible. Now, let me ask you another question. Another question is that what if these projects were not divisible, guys? What if these projects were not divisible? Let me change the color of my pen to a green here. Now, that means in that case, we are looking at absolute NPV rankings, guys. What's the maximum NPV here? 19.3. That's my first project. So let's say undivisible projects or indivisible projects. So we're looking at indivisible projects. So we are looking at if my projects are indivisible, what do we do then? First rank is taken by project E again because that's a maximum NPV. 19.3, is it? So that means you are spending 35 and your remaining funds are 85. The second is again going to project B here, 18.7. Okay, let's select project B and Memon, we are dividing NPV by investment. NPV upon investment, please. Okay, so project B may we invest 40 and we are left with 45. Now, the third ranking is going to project A, guys. The third ranking is going to project A. But can we select project A? It requires 50,000 and we are left with only 45. I don't think so. I don't think so. We can't do E, B and A. We are left with only 45,000. That means we are again forced to probably go for the next NPV. We are forced to go for the next level of NPV. That is option D. That is fourth rank. If I select D, that means we are looking at an investment of 30,000, and we are talking about in terms of project D leaving 15,000 with us. So we are seeing that, okay, E, B and D. And the problem is, because the projects are not divisible, this 15,000 will stay uninvested. This 15,000 is uninvested, guys. Saurabh, 15 or 20? So E may you are investing 35, B may you are investing 40, 15, right? 15. I guess 15 should be left over, not 20. Just double check. I think it's a very, very important and significant understanding of both the aspects, whether the project is divisible or not. Okay, so guys, I hope this is making sense to everyone. So if the projects were not divisible, we are going for E, B and D here, and that's what my decision criteria, because any other combination will give me a lesser NPV. Any other combination will give me a lesser NPV because I'm looking at absolute NPV now. Okay, great, good guys. So let's try to solve this as well. Now let's see, we are talking about testing yourself here. Company has a 1 lakh available for investment and 4 projects. So we are looking at a scenario that projects are independent and divisible. Option number A. Can you tell me what should be the answer here? Quickly, guys. I want a quick answer. Projects are independent and divisible. You need to tell me which projects you should select. Rakesh, but the problem is, in that case, you might not be maximizing the NPV now. Rakesh says take A, B and D. Rakesh, if I would take A, B and D, your NPV is how much? 15 plus 18, 33 and plus 11. That's 44. But in E, B and D, what kind of an NPV you are looking at? We are looking at a NPV of a 49. Rakesh, don't focus on the investment only. Focus on the NPV also. You are using a word, you can enjoy whole investment. I don't agree. I will not be able to enjoy the investment because I will be getting a lesser NPV. I would rather get more NPV and keep 15,000 for my own pocket money. Charu, that was absolute NPV. NPV के bound पे 20, 30, just say like in this case we have NPV, absolute NPV. Don't do anything, just NPV. Okay, guys, what about this one then? So we are looking at a scenario. I'm just waiting for some more responses. Someone said project B, but guys, project divisible hai, so you will be investing the entire 1 lakh, right? So you think project B only? Everyone is like A, B, getting different answers. Guys, projects are divisible. So I think what you need to calculate is a NPV per rupee of investment. So what you need to calculate in this case, you need to understand this also, that what you need to do is you have to calculate NPV upon investment. So that means if I do that, NPV per rupee 1, I'm getting a 0.05, sorry, 0.5, 0.35, 0.48 and 0.30. So let's rank it. Rank 1, rank 2. So if that is the case, I'm actually selecting option A, option B, sorry, option C, and then I'm also looking at any additional 10,000. So 10% of project B probably. So we are looking at project A and C, and then 10% of project B. Make sense, guys? So we have to calculate NPV per rupee of investment. I hope everyone with me now. If we have a divisible project, my ranking is A and C, guys. And then I'm left with 10,000, because if I have 100,000, I have a 1 lakh rupees. If I select project A, I'm investing 40. So that means leftover is 60. If I'm selecting project next rank is C. So C, if I select, is a 50,000. So I'm left with 10,000. So where to invest this 10,000? The next rank is option number D. But D project is for 1 lakh. So I can see only 10%. D project will be 10%. Yeah, absolutely. Saurabh, Pooja, you guys are absolutely perfect. Rakesh, Rohan, Narayanan, I hope you guys are fine now. And Khushi, I think your question, your answer was close, but I think now you got the exact answer. A, C, and 10% of D. But in case of non-divisible projects, as I said, only absolute NPV was fine, right? So rank for the normal NPV, which is the maximum NPV here. Project B, guys, 35,000, number 1 ranking. Next one is project C, number 2 ranking. Next one is project A. The problem in this case is we need to understand you have 2 choices. Look at this. Look at this very important point. Either if the projects are not divisible, if I allocate entirely to A may be spent an entire 1 lakh. So what is the NPV we are getting, guys? NPV we are getting is 35,000. And we have exhausted entire 1 lakh. But what about if I would have selected project B and C? What if I would have invested 90,000 only? That's okay, na? Project is not divisible, so I'm not spending anything else. But B and C combined NPV would be 20 plus 24. Guys, so would you go for option A or B and C? So we are looking at a combination where my NPV is maximum, guys. I hope non-divisible project is clear. So if we go strictly with the ranking, just double check if any other combination is giving me a better NPV, guys. Hope that makes sense to all of you. Guys, I hope I'm making myself clear. The second consecutive example on the same topic. So B and C much better than A, right? So don't kind of go for a blind allocation key. Okay, NPV number 1 ranking, can select everything. Just double check if there is any better NPV also. That's a learning out of this question. But yeah, where the divisible projects are, generally that would be giving you the best answer because you are investing all of the amount. Because in this B and C, imagine you not only you are getting a higher NPV, but also you are saving 10,000. Great, guys. Amazing. I think everyone is saying that you guys understood it. Absolutely perfect, guys. Good round of applause for all of you. Okay, now let's continue the special cases to something called project with unequal lives. So I told you if the projects are with unequal life, where the NPV and the IRR used to give a conflicting conclusion. Now there we need to understand that you could have different issues or different decision factors. One is we are saying that okay, retain an asset or replace it with new one. Or we say that, okay, choose one proposal amongst the two. So there could be a possibilities of confusion where the project is with unequal life. Let's say one project is for 6 years, another project is for 3 years. Now, we are talking about 2 methods to kind of resolve these kind of issues. Replacement chain method and equivalent annualized criterion. Now, what is a replacement chain method, guys? Now, replacement chain method hypothetically assumes that you repeat the shorter project multiple times as if they are available, right? So let's say one project is taking 3 years, another project is taking 6 years. So you repeat the 3 years project twice to compare with the 6-year project. Let's say my project A is taking 3 years, project B is taking 6 years. I will repeat project A twice to compare with project B, because then the size of the two projects become simple. So I would say that we are not actually taking it twice. We are just kind of making a decision more compatible, right? So we are not actually taking that. We are just involved. We're kind of assuming that, okay, let's say if I want to repeat project A twice, then probably my size or the scale of the project becomes, in terms of terms, which becomes with the equal lives, right? So in that case, whichever project is having a highest revised NPV, that can be selected, because now you are doing is a apple to apple comparison, guys. But the problem is, what if you don't have one project of 6 years and another is 3 years? You have one project of 6 years and one project of 4 years. One project is 6 years, one for 4 years. Now don't do that. Okay, let's repeat 6 years project twice and 4 years project thrice. So let's take both of them to 12 years. We are not playing a LCM here, right? You're not going for an LCM here. We're not going for a lowest common multiple. I hope you understand. In that case, so that means if the two projects are of unequal lives and they are not a multiple of each other, I would say go for an equivalent annualized criteria then. What does that mean? One project is for 6 years, another project is for 5 years. What will you do is, you will calculate NPV of both the projects. You will divide the NPV with the unequal lives by their respective present value annuity factors. So whatever the PVAF you would have used, you divide the NPV by that factor. And whichever gives you the highest factor, that will be the selection, guys. So once you select the NPV, you divide that by present value annuity factor, and whichever is giving you a higher number or highest value, that is the project you will be selecting. Let's try to understand this as well. So let's take an example. So this is a company here which says Dhoom company is considering modernizing its production facilities, and it has two proposals under consideration. They have given the expected cash flows with these projects and their NPV with a 12%. Discounting rate is 12%. Now, they have also given probably NPV and IRR. So that's okay. We need to say, okay, which project can be accepted. Now look at this, guys. Project A and project B. We have project A. What is the life of the project A, guys? 6 years. So we are looking at a project A with a life of 6 years here. What's the life of the project B? 3 years. So in the first two rows, you can see project A is giving me an NPV of 649 and IRR of 17.47%. Guys, and project B is giving me an NPV of 515 and IRR of 25.2%. Guys, can you see a conflicting conclusion here? Guys, can you see a conflicting conclusion? Project A and B, A says, okay, go for, NPV says go for project A. IRR says go for project B. So there is a conflicting conclusion anyways. But my point is, I just met a new friend. And the friend's name was replacement chain method. Now this friend tells me, hold on. Why don't you assume that you can repeat B project twice? We are saying that, okay, let's repeat B project twice now, because B is for 3 years. So now both the project can be compatible. A was for 6 years, B was for 3 years. So replacement chain method says, okay, let's repeat the project B. So this section 2000 in outflow, 700, 312 here is now repeated. 2000 investment here, 700, 1300 and 1200. Now compare the project A with the revised project B, guys. Compare these two. Guys, can you please compare a project A and a revised project B? Is there a conflicting conclusion now? Both NPV and IRR indicating project B, guys. So you finally reached a consensus here. There is no conflict anymore. You select project B. But yeah, I agree with you. Probably you might say that, okay, hey, what if what if practically project B is not available twice? That's okay. Practically, obviously, we need to consider other risk factors also. Guys, I hope this is clear to all of you. But the problem is something else. Problem is not this. I have a problem that, okay, this replacement chain method, this is a very good close friend of mine, but this friend doesn't support me always. What if the project A and B are not in multiples? Let's say the life of the project B was not 3 years. Let's say it was 4 years, 5 years. So in that case, what should I do? What if the projects couldn't be repeated? Or the projects were not in multiple of each other? So then there is an example here. Let's say there are two projects, A and project B. Project A gives, this is a different example, not the same one, guys. This is a different example. Project A gives me a NPV of 6,49,000. Project B gives me a 5,15,000. What I've done is, I've taken the present value annuity factors of project A and B and divided the NPV with those. And I got an equivalent analyzed criteria. So I got a higher one for project B, guys. I get a higher one for project B. So I will kind of go for project B in that case. I hope this is making sense to all of you. So when the replacement chain method is not supporting me, I would going for equivalent analyzed criterion, guys, where I am dividing my NPV with a present value annuity factor. Now, present value annuity factor is nothing but the total of the present value factors for the number of years of the project. It clearly indicates that project A is a longer project because my annuity factor is more than project B. The present value annuity factor is more than project B. So that means probably in project A, we are looking at a longer project. Okay, guys, I hope this is clear to all of you. It was again a good one. So now we talk about another interesting special case with respect to a replacement of an existing machinery here. Now, there are certain scenarios we need to understand. You're looking at a replacement decision, very, very important one. So what we need to understand that, yes, probably we are looking at a scenario that, whether an existing asset should be replaced by a new version or probably we want to continue the existing machine. What are the key factors we need to talk about here, right? So replacement of existing machinery here. Pooja, you had a question from the last slide, how we got 882 NPV. So basically what we are looking at is, Pooja, we have just calculated the NPV at 12%. Huh? So you could do that calculation later on. 882 NPV is discounting all of these by 12%. So I'm not showing each and every calculation here. Otherwise, it will take a lot of time just to do a simple calculation over here. Okay, so guys, we're talking about a replacement of existing machinery, that whether an existing asset should be replaced by a newer version of the same or an advanced functionality. Because see, information technology gets upgraded every day. Information technology, your factory or your machinery might get obsolete. So what are the factors you need to consider? I think pretty logical answer. What is the investment value? What is the sale value of the old machinery? Probably. What are the benefits? How much is the operating cash flow increasing? How much is the reduction of the cost? So any relevant cash flow impact, any tax implication of the sale of the old machinery. So we need to consider that there are various factors that need to be taken into account before we take into this consideration. So there are basic steps, guys. Step one is we talk about a net cash outflow. What is a net cash outflow here? Now, in this, basically, we're looking at a situation that is what will be happening today. Now, that is, we are looking at a book value of the old equipment minus market value of the old equipment. Because see, you are selling the old equipment, right? You're selling the old equipment. And if you're selling it, probably there could be a tax saving or a tax payable. So if there is a gain, there is a tax payable. If there is a loss, there could be a tax saving. In case of loss, there could be saving here. And that is one thing. That is, we are talking about at current time. That's what happening when you are planning to go for an initial investment, right? And then, of course, we are looking at the cost of the new equipment will be adjusted with the same. So cost of new equipment minus any tax savings from the sale plus market value of the old equipment is my net cash outflow. What do you mean by this? Net cash outflow, the investment of the new machinery, guys, the cost of the new machinery, 5 lakh, 10 lakh, 20 lakh, whatever. Whatever you would have sold, the cash recovered from the sale of the other machinery, old machinery, existing machinery, and if there was any tax payable or a tax saving, that needs to be adjusted. So that will be my net cash outflow. So it's kind of very similar to my initial investment, right? Net cash outflow. So only difference is it is adjusted with my existing machinery sale and its tax implication. Step two is estimate the change in the cash flow per year. Now the change in cash flow could be change in sales, my revenue going up, reduction in cost, change in depreciation, guys. And if there is a change in depreciation, there would be a tax impact also. Tax shield of the depreciation. That's the stage two. And then we do a present value of the benefit, stage three. So present value of these cash inflows or the cash flows and the salvage value, and we calculate the net present value here. Simple point, if my present value of benefits is more than my cost or my NPV is 0, I kind of accept to go for replace the machinery, or I don't accept it, I reject it. Simple rule, I'm going to accept or reject. Okay, guys, I think this makes sense. But what I also feel is, okay, there is a question from Shraddha here. Shraddha is asking, sir, is this replacement of existing machinery method? Yes. So that is something which is, it's not a method actually. It's like just more of a scenario which could be considered for an NPV method. It's not a kind of a, I would not say this is a something new concept we are talking about. It's very logical that we need to compare, okay, I have an existing scheme of cash flows, I have a new cash flows proposed scheme. So whether I should go with that ahead or not? It's a kind of a application of an NPV method itself. I would frame it that way, Shraddha. But yeah, so probably more from a perspective of the illustration that has been recently added. Okay, so guys, let's do one thing. It's already 7:20. Let's take a quick 10 minutes break, come back and solve. So there are two illustrations here with respect to the replacement machinery. Now, guys, from this point, we will be talking about a lot of practice. So after the break, we have 1 hour of practice with us. And then some questions after that, you guys will have at your disposal for your homework. And I will be uploading the solutions file as well by tomorrow, so that you guys can do the homework, compare your answers, and you guys can feel comfortable. So let's take a 10 minutes break, guys, right now, and come back and do some practice. Okay, see you then after 10 minutes. So we have break now. So, welcome back, everyone. I hope you guys are all freshen up and proper, proper energy required for a good practice session now. So, last 1 hour, we will be doing some questions practice in lecture, and then other questions in the notes which I have shared with you, probably for you guys to practice. And you will guys have the solution probably in another file by tomorrow uploaded, right? So this question, which talks about of a machinery, Zavli Limited having a machine which has been operation for 3 years. The machine has a remaining estimated useful life of 5 years here. So let's talk about this one. A remaining estimated life of 5 years with no salvage value at the end. Current market value, however, is 2 lakhs. Now, what we are looking here is that company is considering a proposal to a new model of the machine. That's okay. That's not bad. You want to upgrade, that's okay. Absolutely fine. So if I want to replace, there are different proposals here. Existing machine and a new machine. So we have cost given to us, estimated life given to us, salvage value, annual output. Look at that huge jump, guys. Huge jump. Annual output increasing from 30,000 to 75,000 annual output. Selling price is same. Annual operating hours is same. Material cost, labor cost per hour has gone up, and indirect cash cost per annum has a slight increase as well. Company uses return on value of depreciation of 20%, and it has several machines in the block of assets. Very important point. Several other machines in the block of assets. Income tax rate is 30%, and you do not make any investment if the yield is less than 12%. So the question is whether we should replace the existing machine. So that means 12% is my WACC. 12% is my hurdle rate, and the factors given to us for 5 years for 12%. That's amazing. Guys, I think this is an interesting question, isn't it? The question is, we should be actually accepting it or rejecting it. That's the simple question. So, and the entire steps which we talked about in the last slide are more of a steps which indicates that, hey, you guys need to ensure that on an incremental basis, whether I have more present value of benefits than the cost. So let's talk about all these factors which make sense. Now, my question is that okay, if I want to, probably go with a new machinery, what's going to happen here? So let's talk about one by one. Initial outflows. That is my first step, guys. I hope everyone with me here. That is my first step. I have a new machinery costing 10 lakhs. And the existing, proceeds -2 is giving me an initial outflow of 8 lakhs here. I hope this is clear to all of you. That's the most simple part. Now, is there any gain or loss or tax on the same? The question itself said that there are many other machines in the block of assets. So if they are talking about block of assets, that means we are not looking at any gain or loss or a tax impact. So tax implication is not required here. So my initial outflows are 8 lakhs. Simple. Now, we need to understand what will be the change in depreciation, because we know that, hey, that probably I'm looking at a scenario that my output has gone up, my material cost is same, but my labor cost has gone up. That's okay. But because of the changes in the cost of the machinery, my depreciation base has also gone changed. My depreciation, I was already charging some depreciation. Now that needs to be changed, guys. What was the cost of the existing machinery, guys? We're looking at a 3,30,000. And what is the depreciation method you are using? WDV of 20%. So we need to consider that my cost of the existing machinery is 3,30,000. Based on the WDV, I have 66,000 for the first year That means if I see what will be my WDV here, guys? 3,30,000 minus 66. So that means I'm getting a 264. And the depreciation for second year accordingly 52,800. That means I'm getting a 211,200 now. And then I again get a 42,240. So that means my WDV of the existing machine as of today is a 168,960, guys. That is something you need to understand. My WDV of the existing machinery is 168,960. Guys, remember, some of you asked me question today when we started the session. Couple of students asked me, sir, what is block of assets? This is the question which will make your block of assets concept absolutely clear. There are other machines also. Now, what is happening is, the existing machine hai, the value of that machine is 1,68,000. What I'm adding to that machine is 10 lakhs. So I get a kind of a scenario of a total 11,68,000. But I'm selling this machine is for 2 lakhs. I'm selling the existing machine for 2 lakhs. So there is no gain or loss, but 11,68,000 minus 2 lakh is giving me a 9,68,960 net change, guys. Net change in the block is 9,68,960. That's what we are looking at. But the point is, this is the new machine. We already had a 1,68,960 as a WDV of the existing machine. Had we not purchased a new machinery, I would have carried on depreciating the existing machine at 168,960. If we buy a new machinery, my base becomes a 9,68,960. So guys, what has been the incremental value? Can anyone tell me here? If I would not have purchased a new machinery, I would have carried on depreciating 1,68,960, guys. Does this make sense? But if I am purchasing a new machinery, my depreciation base becomes 9,68,000. So that means the incremental change because of the decision is only and only 8 lakhs. How do I come at 8 lakhs? 9,68,960 minus 1,68,960. I hope everyone clear with this 8 lakh value, guys. Yeah, Charu, absolutely correct. I hope everyone is clear. I think this is a very important point, but I hope you are understanding simultaneously. So I'm just assuming that everyone is with me till this 8 lakh point. Yes, this is a very, very interesting question. So now let's talk about apart from depreciation, what else has changed? My annual output. So let's see what is the differential between the other factors. I have an increase in annual output from a 30,000 to a 75,000, 30,000 to a 75,000, guys. So I'm looking at a 45,000 differential. So sales revenue was 15. So 45,000 into 15. How much by sales have gone up? 6,75,000. My sales have gone up by 6,75,000. Material cost 4 into 45. 1,80,000, guys. And the labor is changed, by the way. I can't apply a shortcut. So there was a 40 rupees labor, now 70 rupees labor. So earlier you had a 1,20,000, now it's 2,10,000. So the change is 90 here. Marginal change was indirect cost as well. 15,000. So total cost which has gone up is 285. 180 plus 90 plus 15. 285. That means 6,75,000 may say, when I reduce 285, I am getting a profit before depreciation and tax is 390. So I'm getting a 675 minus incremental total cost of 285 So the change in profit before tax and depreciation is 3,90,000. 3,90,000. This is making sense to all of you. I'm assuming that. Very interesting question, but if you follow sequentially, it should not be a problem, guys. Okay. So in this case, we are looking at a incremental NPV now. Now we know that the problem with us in this case that we had a WDV depreciation. I have to calculate yearly numbers. If it was a straight line method, we would have just used a present value annuity factor, guys. If this was a straight line depreciation, I would have used a present value annuity factor. But now we have a different depreciation every year. 3,90,000 is okay. Every year, that's the saving I just calculated. But depreciation is at WDV. 8 lakh minus 160. 640 aega, 640 into 20%, and then accordingly my depreciation will go on decreasing. So then I calculate my profit before tax, and then I calculate the tax here, tax at the 30%. So which is giving me a net cash flows. Guys, any idea how I'm calculating net cash flows? Of course, profit before tax 2,30,000. minus tax of 69,000, and then we add back the depreciation, guys. So net cash flow is PBT minus tax plus depreciation. So this is a net cash flow. I've added back the depreciation. Remember my method number 1. 230 minus 69 is 161. 161 plus depreciation of 160 is 321, guys. So accordingly, all the 5 years, I have to calculate the net cash flows here. And when I calculate the net cash flows for all the 5 years, you can do the calculations later on. What we are looking at is a present value of the cash flows coming at to be a 11,06,000 here. 11,06,000. And then I think we need to also understand that they had given some information to us in terms of the salvage value. You think we have some information which could be relevant for us here? We are talking about a salvage value of a 40,000. So that salvage value is also considered. So salvage value of the new machine, 40,000. But guys, that is after the 5th year, isn't it? So we take 0.567 as a discounting factor. So my total becomes 11,28,000. 11,28,000, and my initial cash outflow was 8 lakhs, guys. So 1128 minus 8 lakhs give me a positive NPV of 3,28,000. Anyone would suggest that, hey guys, go for the replacement. This is a good news. That means existing machinery should be replaced. You are looking at a positive NPV, guys. I think a very, very interesting, comprehensive question for all of you here. But you need to be careful at each and every step. As a quick recap, the first step was calculating the initial cash outflow. Then to calculate the differential profit before tax, we also needed to have a depreciation value. So we calculated the base for the depreciation here, 8 lakhs. And then we arrived at, okay, what is the difference in my profit before tax and depreciation? And at a last stage, I applied depreciation and calculated my cash flows. These are incremental cash flows, guys. Remember, all the discussion is done based on the incremental values. Everything is based on the incremental here. Even the initial outflow was incremental, guys. So I think that was wonderful. I can see a lot of confirmations coming from Charu, Pooja, Sandeep, Vrinda, everyone is looking to have understood the question and understood the conclusion as well. So good, guys. So let's do one thing. So one illustration I have kind of walked you through here. I'm giving you one question as a homework here. The next question which talks about the HMR limited. So this question will be a homework for you guys. This is again the machine replacement. And I will be uploading, as I'm promising, another file for you guys by tomorrow that will be based on the solutions, guys. So you can download that. I'm just giving you one day intentionally so that you guys do some practice tomorrow morning. And by evening or later in the day tomorrow, I will be uploading another file which will be having all these solutions for the same. So let's do a recap. It's a good summary of whatever we have done in the capital budgeting. So earlier, day before yesterday, we talked about non-discounted techniques. We talk about a payback period. We talk about the ARR. Then we discussed a net present value. If the NPV is more than 0, accept the project. We also talk about the profitability index. If it's more than 1, accept the project. IRR, if it is more than my WACC, then you accept the project. So all this is a good kind of a discussion. But the differentiation is, are we talking about the independent project or a mutually exclusive? Because in the mutually exclusive, of course, we are going for the project which is giving me a highest NPV, highest IRR, or highest profitability index. Or if we are calculating the payback method, we're looking at, hey, the least payback. Yes, Memen. Memen is asking me if the answers are positive, we change. Yeah. But be careful, what are we looking in terms of positive? We are not looking at the incremental cost, we are looking at the savings, right? So guys, time for some brain teasers here. So let's see who gives me an answer for question number 1 and question number 2. So there was a question coming in from the last couple of slides. How come the 1,68,960 coming here? That's a written down value. Ma'am, in that case, you need to understand there was an original cost of 3,30,000. After reducing the 3 years depreciation, that's a written down value of today. This is written down value today. Because that existing machinery is 3 years old. 1,68,960 is that today's written down value. I hope that makes sense. So guys, let's now target a couple of MCQs here. Question number 1. While evaluating the investments, a release of working capital at the end of the project life should be considered as what? Guys, mind you, the word is release, not restoration. The release of working capital. Should it be inflow? Should be outflow? Should be having no effect? Guys, what should be the answer here? I think everyone, Charu, Rohan, Pooja, everyone is giving me option number A as answer. So that's absolutely correct, guys. Option number A is the answer. So option number A is the answer. Vrinda, I think you need to double check. Release of the working capital. Initially, it's an outflow. Later on, it's an inflow. Release. If the word was restore, then it would have been outflow. Release means inflow. Okay. Guys, what about question number 2 here? What about question number 2? Multiple IRRs are obtained when? Today only I talked about this. A multiple IRR situation, guys. Okay, so everyone is telling me option number B. We talked about when in the case of IRR method there are multiple cash outflows. That means cash flows reverse their signs during the project. That means we are talking about multiple cash outflows. That's amazing, guys. I hope everyone is clear now. I can see answer coming in from most of you as question number 2 of answer B. Right? So some of you selected option number A, but guys, that is option number B here. So we discussed this today itself. Okay. So guys, now you might have a lot of questions, in all approximately 6-7 questions, I guess, in the notes I shared. We'll try to cover some of them in the class, but some other questions will be kind of a homework for you guys to do some practice. So let's start our discussion. So let me just pick out the first question which I want to discuss today. So the first question is a pretty basic question, guys. I expect you guys to do this as a homework. This is the question based on the Gamma company, where you have some cash flows and you are required to calculate payback, ARR, IRR. This has to be a homework for you guys. I want to pick, in fact, a relevantly an interesting question. So let's talk about a question which is talking about a question relates to unlimited or unlock limited question on the screen right now. So let's talk about this question. So unlock limited question wants to replace its old machine, kind of a similar thought process we had with that illustration though. So it's with a new automatic machine here, 2 models A and B are available at the same cost of 5 lakhs. Salvage value of the old machine is 1 lakh. The utilities of the existing machine can be used if the company purchases A. Now, this is an interesting question, guys. So, you are talking about replacement, but the replacement has a choice, A or B. So, you're not looking for, okay, whether. So, question is whether you should. Question is not whether you should replace or not. Question is whether it should be A or B. So, it's a different question altogether. Now, the utilities of existing machine can be used if the company purchases A. And the additional cost of the utilities to be purchased in that case are 1 lakhs. Okay. If the company purchases B, the existing cost of the utilities will be 2 lakhs here. So if you purchase A, you will only spend 1 lakh extra. If you purchase B, you're spending 2 lakhs extra. And the salvage of the value of the old utilities will be 0.2 lakhs. That means net of 1.8. 2 minus 0.2, 1.8. And they're given some earnings after taxation, guys. So earnings after taxation is given to us. And they're given, okay, target return is 15%. You are required to compute 2 machines separately, NPV and a discounted payback and a desirability index. And advise which of the 2 machines is selected. So the question is not that, okay, whether you replace or not. It's not a replacement question. It's about whether we are looking at a question number, machine number A or B. So this is the information given to us. So you can see there are different cash flows, different salvage values. So you can see that machine A is giving you larger cash flows throughout 5 years. Machine B is giving us larger cash flows in the initial years, and the cash flows become less and less as the life goes on. So we need to compute which machine probably will give me a higher NPV or a lower discounted payback or a higher desirability index. Make sense, guys? We are talking about a situation which is pretty straightforward though, especially with the aspect that they are telling you, okay, which is the machine you need to select here. So let's talk about this. Let's talk about this question together. In this case, both the machines have a outflow of 5 lakhs and 5 lakhs 80,000. There is a difference between 5 lakhs and 5 lakh 80,000. Can anyone tell me why is that difference? Because if I'm looking at the question here, both the machines were taking a cost of 5 lakhs. But what we are taking here is, in case of machine B, we are looking at a differential value. Any thoughts, guys? Why is that? Why is the same? Let me look at your responses here. So we are seeing that both the machines are costing 5 lakhs. Guys, need to understand there is a salvage machine value of old machine of 1 lakh. So how I am coming up with this outflow is, in case of machine A, we are looking at a 5 lakhs minus salvage value of a 1 lakh and then a utility cost of a 1 lakh again. So you are talking about a 5 lakh for machine A. In case of machine B though, the cost was 5 lakhs. The salvage value of the existing machine is again 1 lakh. But the utilities cost was 2 lakhs net of 20,000 of the scrap value of the existing utility. That was 1,80,000. So you're coming up with a 5,80,000, guys. Can you please confirm if this initial outflow is clear to all of you? Jamil, that was perfect answer. Rohan, absolutely amazing. So I'm getting some responses already, guys. I think that means you did your homework. You did some practice. I'm impressed, guys. So basically, we are looking at two separate options here. Option number A and option number B, or machine A or machine B, with a different net outflows. So we need to understand that, hey, cost was 5 lakhs, but outflow could be different because of the different parameters. So that means my utilities in machine B, the existing utilities could not be used. That made the difference here. But rest of the game is pretty easy, right? That was the just tricky part. Rest of the game is given to us, right? We are given to us all these cash flows. For all the 5 machines, we are given the cash flows here. So we are looking at a simple calculation of a present value. That means you're just taking the present value of 15%. We're calculating the present value. That means NPV in case of machine A. Rest of the sum, rest of the question is probably just a multiplication of these cash flows with the discounting factors, guys. So you're looking at a 1 lakh, 150, 180, 2 lakhs and 220. Don't need to do much efforts over there, guys. Don't need to do much efforts. The only thing probably which you need to consider is in which year, guys. Any thoughts? Which year might be the only consideration? That is the last year, guys. The last year. Because in the last year, what you are seeing here is a different salvage value. Machine A has a 50,000. Machine B has a 60,000. That means machine A has a inflows of a 2,20,000 and machine B is having a 1 lakh. So that's where you just need to be extra careful when we are plotting these numbers. And when I'm adding up the NPV for a machine A by adding up the present value of the outflows and inflows, because my NPV is nothing but present value of cash inflow minus the initial investment, I'm getting a 43,800, guys, for machine A, and I'm talking about a 19,300 for machine B. Guys, I think your decision is very straightforward. In terms of NPV, it's a 43,800 higher NPV for machine A. Let's select machine A. I think if I talk about even from a perspective of, okay, what is my payback? What is my payback, guys? The call of the question was 3 things. We're talking about NPV, machine A, definitely a selection. Second part was discounted payback, guys. Now, in this case, we don't have a common cash flows. Generally, for the discounted payback, we have to follow a cumulative approach here. So let's say, what are my cumulative inflows? So my cumulative inflows are kind of coming up somewhere closing on the 5 lakhs mark, somewhere in the last year, guys, 5th year. I can see the 5 lakh mark is actually touched upon for the 5th year for both the machines, because in the machine B, I have 5,80,000 guys. In the machine B, I have 5,80,000 to be recovered. And that is also touched in the 5th year. That means my payback is 4 plus. That has to be 4 plus, guys. And if we calculate our discounted payback, we are just marginally saying that, okay, machine A is slightly better. Just marginally, thus fractionally, the machine A is kind of recovering my money is 4.60 instead of 4.61 years. I hope everyone is aware of how we calculated that. When we did the last lecture on day before yesterday on Tuesday, we're talking about, okay, 4 plus, that means a differential amount of 5 lakhs. So we're looking at, hey, 66,200 upon the cash flows in the 5th year, guys. The present value of the cash flows in the 5th year is 1,10,000. So you can probably check how we are arriving at that number. So if you do that quick calculation, you are talking about a 4.60. Similarly, for the machine B, we are saying, okay, it's a 4.61. So I have a question here from Sandeep. Sandeep says how we are looking at 20,000. Which one you are asking, Sandeep? Okay, 20,000. You're talking about the initial outflow. If that is your question, in the given information, if you see this line, the salvage value of the old utilities is 0.2 lakhs. Sandeep, if you are not using the existing utilities, you are purchasing the new utilities for 2 lakhs. That means net it is a 1.8 lakhs. So 2 minus 20,000. Sandeep, does that make sense? I hope this is absolutely clear, guys. So my selection as of now for NPV is also machinery A. My discounted payback is also machinery A. But when I look at present, my desirability factor or a profitability index, that also had to be machine A, guys, because I am having a better NPV. So my desired or profitability index, nothing is by present value of cash inflows upon the outflows. That means even desirability index anyways will be in sync with the NPV anyhow. Guys, I hope this is clear to all of you. Sandeep, I hope all the doubts are cleared. And what about everyone else, guys? Can we just get a quick confirmation, guys, if all of this is clear to all of you? Any doubts on this one, on this case study, let me know, please. Okay, second question I'm getting from Vrinda. Vrinda says 66,200. How did I get it? Vrinda, that's a very good question. Vrinda, till 4th year, how much has been recovered? Vrinda, are you with me? If I may conclude that till the 4th year, I have recovered 4,33,800, Vrinda. And for the machine A, what is the amount I'm looking at? 5 lakhs to be recovered because we are talking about payback. 4,33,800 is already recovered. How much is left to be recovered here? 66,200. And how much was the total inflow of that year? 1,10,000 in terms of discounted value. So Vrinda, I hope that is clear. So accordingly you could do for the machine B also na 4 plus वहां पे 580 recover होना था 580,000 right 5,80,000 so 580 minus 543,800 so we are looking at a 36,200 over there and we are looking at a discounted value of just give me a second, just quickly double checking. So we're looking at a 549,300, right? So we're looking at 30,700, not 36,200. So we're looking at a 30,700 that divided by 50,000. So 30,700 divided by 50,000, we are getting a 4.61. Okay, great. So I get a confirmation from everyone, although that this is clear to all of you. Okay, I've got an interesting point. IRR differs from 0.2% from different NPV. That's okay. Rohan, that's okay. See, generally in a hit and trial method, when you select different rates as an NPV, there could be fractional differences, but that is okay because ideally that should be not too much. But negligible difference could be there because of the calculation or rounding of issues. That's absolutely fine. Okay, guys, let's move on to another practice question then. Let's move on to another question here. Now, the next question which I want to discuss here is one of my favorite questions. Now, this pertains to not to Bajrangi Bhaijan, but the question talks about the Bajrangi Chimney Company. So let's talk about this one also. This is one of our very, very good questions. So I want all the attention, please, here. So in this one, Bajrangi Chimney Company is evaluating 3 investment situations. One is producing to understand the consequences, the impact, which one is best. We know that capital vesting decisions are important. PI was profitability index, Charu. NPV, the cash flows, present value of the cash inflows upon outflows. Profitability index. Okay, so we need to understand what are my interpretations or implications of the decision here. They've given various important information, guys. If only one project is undertaken, then its standalone expected present value and the amount of investment is given to us. The question is, if we are selecting only one project, so that means we have a possibility, by the way, maybe that we might want to end up into accepting probably more than one investment situation. One is a new line, one is expansion, one is probably moving on to the exhaust. So be careful, guys. This is only information which is given that if only one project is undertaken. Now, there are certain informations given to us. If projects 1 and 2 are jointly undertaken, then there will be no savings, investment required, and present values will be simply individual totals. What does that mean? Abhijit was asking me a question whether salvage value is needed to be minus from initial investment if life is not given. Abhijit, again, generally when the salvage value is given to you and life is given, we consider that for depreciation, right? And as a terminal year cash flows, we can consider that as well. Okay. But anyways, let's come back to this one now. Let's focus on this one, guys. This is a very, very interesting and important question, guys. So if project 1 and 2 are jointly taken, they say that, okay, if you want to undertake the project 1 and 2, we need to understand that, okay, we will just add this 1 and 2 in terms of investment and in terms of the present value of the future cash flows. So whatever the result will be just a summation of 1 and 2. Now my question is, I can see in both project 1 and 2, my future cash flows present value is more than the investment. So probably I'm looking at a positive NPV. Can anyone tell me here, would you go for an individual project only, or you would actually go for a 1 and 2 then? I think if both the projects are giving you NPV and let's say a capital is not a problem, I would go for 1 and 2. Why not, right? I would go for 1 and 2. Why not? It will be maximizing my NPV. Guys, making sense that way? And accordingly, we need to consider what are the other possible combinations. Mind you, if 1 and 2 were undertaking together, there were no savings. See, generally, if you go for a multiple projects, practically, if you think over, there could be some saving of resources, guys. There could be possibility where you get some kind of an arbitrage. So, Vrinda, absolutely, we'll go for 1 and 2. So let's talk about other combination. What are the other combinations available to us here? With projects 1 and 3, we're looking at 1 and 3 now. Economies are possible in investment because one of the machines acquired can be used in both the production processes. This is what I was telling you. 1 and 3 may probably you have some machines which could be common. What they are saying is total investment required for project 1 and 3 combined is 4,40,000 guys. Now, if we were undertaking project 1 and 3 individually, guys, what was the investment, guys? Can anyone tell me? If I undertake 1 individually and 3 individually, 1 may, what is the investment? 2 lakhs. In project 3, what is the investment? 2,70,000. If I add them up, my total investment should have been 4,70,000. My total investment should have been 4,70,000, but they are saying that, okay, my total investment will be 4,40,000. Why? Because they have given us that there is economy of scale, or there is an economy in terms of machines. We are able to use a common machine. We don't need to purchase 2 separate machines. I hope 4,40,000 is clear to everyone. Now, yeah, absolutely perfect. Rohan, Charu, Pooja, you are absolutely correct. Now let's talk about another possibility, guys, here. Another possibility. They're giving us if project 2 and 3 are undertaken, guys. 2 and 3. They are saying there are economies to be achieved in marketing and producing products, but not in investment. They say that, hey guys, if we are talking about project 2 and project 3, we are sorry. We're sorry that investment will be 1,15,000 plus 270. But what we can do is we can probably save some cost. So that means in that case, my cash flow for project 2 and 3 will be 6,20,000 guys. Right now it is 1,85,000 and 4 lakhs, which is like total of a 585. But what we are saying is that instead of 585, we are using 6,20,000 guys. So that means 35,000 of cost reduction probably, or whatever, because these are the present values. These are the present values, right? Make sense, everyone? Okay, so we talk about 1 and 2, we talk about 1 and 3, and we talk about 2 and 3. What's the other combination left, guys? We talk about 1 and 2, 1 and 3, 2 and 3. We also talk about individual options. The only option which we are left is we're talking about, okay, hey, what happens if we are seeing all the 3 projects together? Let's say, what if all the 3 projects are undertaken simultaneously? What they are saying is, this is very important point. Economies noted will still hold. Wow. You are talking about 1, 2, and 3. What is investment, guys? What was the combination in which there was an economy? 1 and 3, right? So investment will be 1 and 3, 4,40,000. 2 May, there is a 1,15,000. So what is the investment here? 5,55,000 probably. Make sense? Guys, can anyone confirm that? Does it make sense to all of you? Or something else? Or something else? But hold on for a moment. They are saying that there will be also, last line, 1,25,000 extension will be necessary because you don't have space. Oh God, what do we have here? We don't have space. That means my investment will be increased by 1,25,000. That means 6,80,000 will be my investment. That's so unfortunate. We don't have space for 1, 2, and 3. They said, okay, don't worry, 1,25,000 invest additionally. That's the problem here. We just saved 30, but we're spending 1,25,000 here. Let's see, we'll see the comparison. But what about the cash flows, guys? What about the cash flows? They say that economies still hold. So the only economy we had was when 2 and 3 were taken. Instead of 585, we are talking about a 620. But what about the project 1, 290? Hey, we are looking at 9,10,000, guys. 9,10,000. So the cash flows will be 9,10,000 then. I hope this makes sense to everyone. So in all the possible combinations, what do we have right now? We have investments and we have total cash flows. That means what we need to compare is NPV, guys. Is everyone ready to see the results? So now let's calculate. Let's compare the NPV, guys. Look at this. First possibility is project 1 individually, project 2 individually, project 3 individually. What is my NPV? 90, 70, 1,30,000. Okay. So that means this is gone. This is gone. I might still think about this. But hold on, we had other combination as well. What about the combinations of 2 projects? What about the combination of 2 projects? 1 and 2, 1 and 3, and 2 and 3. Out of all these 3, we are looking at 1 and 3 is the winner. So now we have single project. If you want to do single project, we are looking at a 1,30,000. If you are looking at a 2 possible combinations, we are looking at a 2,50,000 as a best combination for us. But look at the last option. What about all the 3 projects taken together? That 1,25,000 did not do good to us. That 1,25,000 probably hit us hard. And we can see that the only benefit we are getting is a 2,30,000 here. That means the best combination of these 3 has to be the 2,50,000 is the winner, guys. That means go for project 1 and 3. Go for project 1 and 3, guys. So 1,25,000 is something that hit us hard over there. Guys, make sense to everyone? What about our Bajrangi Bhaijan or the Bajrangi Chimney Limited? Interesting question, isn't it? Not much of a calculation though, but I think an analytical approach could be something which you need to have to understand the various combinations and permutations here. Great, guys. So I think with the due respect to the time, let's move on to another question here. And let me just quickly go for that. Just give me a second. So let's talk about then another question which we are talking about with respect to a modernization and all. So we are looking for this question which talks about of a situation where we are looking at modernizing the equipment or to buy a new machine. Now this is again a different variant for machinery based questions where we are having a existing machine. We have 2 options, whether we go for a modernization or we go for a buying of a new machine. So let's talk about this one. So the general manager of Mary Limited is considering the replacement of 5-year-old equipment. Company has to incur excessive maintenance cost of the equipment here. The equipment is again has a 0 written down value. it can be modernized at a cost of 1,40,000. So if you're going for a modernization, we are looking at, okay, a cost of 1,40,000 for us. Enhancing the economic life to be a 5 years. Now, the equipment could instead be sold for a 30,000 after 5 years then. And modernization would also help in material handling and in reducing labor. Of course, we are upgrading it with the latest technology. But what is the other alternative for us? Another alternative is to buy a new machine at a cost of 3,50,000 with the economic life of 5 years, salvage value of 60. The new machine is expected to be more efficient in reducing the cost of material handling, labor, maintenance, and repairs. So they have given some information here. Annual cost right now with the existing machine, you're saying that, okay, hey, you're saying that, okay, it's a 1,20,000 cost. Wow. If we try to modernize it, we save in terms of wages, we save in terms of supervision, we save everywhere. And my cost kind of gets reduced to a 70,500 guys. But look at that. What happens if I'm going for a new machine? Further going down, further drilling down to a mere 39,500. That's it. But are we having a saving free of cost? I don't think so. We're getting that saving probably by incurring some extra amount. Question from Charu. Question says, if the projects are divisible, then we have to rank on the basis of NPV from PVF, and if not, no. If the projects are divisible, we were ranking up NPV upon, we're calculating NPV per rupee of investment, Charu. So we calculate NPV divided by the initial investment. So we calculate NPV per rupee invested. You rank as per them. But when it is non-divisible, you are ranking on absolute NPV. But be careful, when you are using the absolute NPV, you are selecting the best possible combination. That's important for you guys. Charu, I hope that makes sense. Okay, so guys, coming back on this one. So we are looking at a very interesting case study with us, which says that, okay, existing modernization and new machines. So there are different possibilities. And we need to understand that, okay, hey, the company should modernize or buy a new machine. What we are clearly seeing here in this case, guys, that we are spending something more to kind of save more. What should be my decision criteria, guys, then, in that case? What do you think? Maybe I should consider savings for both modernization and new machine, guys. What do you think? We can see that what are the savings from modernization, because I have some cost from existing equipment, right? And then I'm also talking about a new machine scenario. So what are the savings over there? And then probably we can compare those savings with respect to the incremental cash outflows. So that those are the two steps we need to do, guys. Is everyone with me on this? So probably we need to consider that, hey, what are my savings in respect to the modernization? What are my savings with respect to the new machine? That means that happens to be an inflow for us. And then we will compare what are the costs we are incurring. That's the initial investment. It could be 1,40,000, it could be 3,50,000. Okay, so let's talk about this. Now, the existing equipment. So what we are doing here is we are just understanding the annual savings that is more from an incremental perspective, right? So existing equipment, this is the information given to us in the question of 1,20,000. And in the modernization, we have 70,500. So the saving we are having is a 49,500, guys. Whereas in terms of new machine, I have more savings. I have another saving of 31,000. So saving of 49,500 and 80,500 here. But my question is, what is the depreciation here? Guys, what is the depreciation? Let's go back. New machine. Guys, new machine. We are looking at 3,50,000. looking at a salvage value of a 60. So that's 290 upon 5. 290 upon 5. So we are looking at a depreciation of a 58,000 here. And in this case, we were talking about, okay, that 1,40,000 could have been spent. 1,40,000 could be spent. And we are looking at that, okay, we could send it for a 30,000 here. So 1,10,000 divided by 5. So we are getting a depreciation of 22, guys. I hope this makes sense. So getting a depreciation of a 58 versus 22 here. So that means the total savings, but by the way, depreciation is non-cash. So we are following the first method. We will be reducing the depreciation. We'll see the after-tax savings and we'll add back the depreciation, guys. So total saving after depreciation, I would say, is 27,500 and 22,500. After tax, it's 13 and 11. And we add back the depreciation to get our incremental annual cash flows. Because depreciation was huge in terms of new machine because we are incurring huge amount. So my incremental annual cash inflows is 35,750 for a modernization case and a 69,250 for a new machine case. Guys, everyone with me on this? Till this point, I hope everyone is clear. I hope how we calculated the depreciation, the incremental savings, that's okay with everyone. So what we are just calculating is incremental annual cash inflows, that is a 35 and 69. But what we also need to consider is the outflow, guys. Let's talk about that and then we will compare, okay, which is giving me a better NPV over there. So my initial cash outflow is 1,40,000 for modernization, and for new machine it was 3,50,000, guys. So that's the initial outflow. We just calculated 35,750 and 69,250. That is, we are discounting the rate of return for 10%, and we are looking for 5 years. And you remember we calculated that day we were talking about the present value factor of a 3.79. So what we are doing here is we are multiplying that present value annuity factor because we are looking at a per year same number. We are looking at a per year same number. So what we are getting here is 1,35,000 and 2,60,000, 2,62,000 as a present value of the incremental cash inflows or the savings, I would say. Savings is nothing but inflows, guys. But remember, there were also salvage values of 30,000 and 60,000 that also needed to be discounted at the present value factor for 5th year for ₹1. So these factors coming out to be a 1.10 to the power 5. So the total present value of cash inflows is 1,54,000 versus 2,99,000. Guys, do you think buying a new machine is a good idea here? Guys, do you think buying a new machine is a good idea here? Any thoughts? Is buying a new machine good idea, guys? What's your opinion on this? So Rohan says modernization should be preferred. Pooja, thanks for confirming. So that means if you see my initial outflow for a new machine was 3,50,000, but my cash inflows present value is hardly 299. So I'm looking at a 50,000 negative net present value, guys. This proposal definitely seems to not to impress anyone, neither me nor you guys. This proposal should be a big no here. So that means probably we are going for a modernization in this case, because we are looking at a negative NPV. We don't want our finance manager to have a sulky face. We ensure that, okay, everyone is happy. So modernization has to be preferred. Guys, I hope this is absolutely clear to you. Yeah, I think I just got responses from Abhijit, Vrinda, Pooja, Sandeep. Everyone is clear. Good, guys. Okay, guys. So I think we kind of solved 3 or 4 questions in the class, and that was amazing. And you have some more practice questions. Around 3 or 4 questions more, which you could do it on your own, which is related to a city clap company. Then we have a couple of questions which are more of basic, like Shiv Limited, and one is ANR. So I request you guys to kind of cover up these questions as a homework, and I'm sure you will find it pretty on the basis on the standard what we have discussed till now. And I'm pretty sure that your concepts with respect to the NPV, IRR, ARR, whatever, is absolutely clear with all respective aspects, especially the aspect with respect to a decision making of an existing machinery or a replacement. I think we walked about almost 3 or 4 different examples today, which are talking about variations of the machinery related decisions. So I'm sure that is pretty much clear to you guys. So I request you all to do your homework. I'm just kind of relying on you guys, counting it on you that you might do some practice. Try to do it by tomorrow, guys. That means that what does that mean is that by the time I will be uploading the file with the solutions, you probably can compare your workings with the final one, right? So yes, Pooja. So all the questions selected by me is either from your your study material, or from your past year questions. So don't worry. So guys, as I'm promising, tomorrow by later end of the day or on Saturday morning, you will get the solution files. But the request is the remaining 3 or 4 questions which I included for your practice, you guys need to do your homework. I hope you guys promise me that. And remember, as I always say, that 3 things which always will take to you different heights. It's your hard work, discipline, and dedication. And I'm sure you guys are all kind of doing that. And today was amazing as always. With respect to any other session, I am really enjoying your company, guys. I'm sure you guys had wonderful couple of sessions with respect to capital budgeting. I hope I was able to solve all your questions or probably resolve all your queries. And I'm pretty sure we will have a lot more fun in a couple of weeks' time, probably with respect to the working capital management. So that is something where we will have a lot of fun. Those are the few important units. We'll talk about a lot to cover in those 2 lectures. But till then, I'm sure you will carry on with your study plans. You will carry on with the good work. It was amazing, guys. You are always an amazing audience, group of students who are working hard. And I'm sure, wish you all the best to make sure that you achieve your dreams with respect to your planning and hard work, guys. Take care, all of you. Stay healthy. Happy studying time. Good evening to all of you. Cheers till we meet next time. Good night.